Alright, so let's first clarify what this course is about. This course is about, let's see, maybe we should just even turn this on. Right?
It's on.
It's already on?
It's on.
Right, so first of all, well, we begin this course in real estate investments, but it's also real estate finance. Now, what is the meaning of finance? The meaning of finance, which has been established over the last 50 to 100 years, means raising of funds. Finance is usually associated with the liability side of the balance sheet. In other words, finance is about how you get the money, how you raise the money. In other words, how you finance it. The verb to finance means to raise funds. Now, some people think or like to say is to raise money, but the answer is not necessarily. You might be raising capital. You might be raising other sources of funds than pure cash. Alright, so it's very important to understand that it's the overall level of raising. In the most general word that we have in finance is funds. Historically, finance was developed as a subject which had a very simple purpose: to manage the money of the king, to manage the treasury. Of course, it was developed back then because the king and the treasury had a significant pool of money that needed to be managed. Almost everybody else did not need to be manage their money because they lived kind of like from crop to crop, the equivalent of today's paycheck to paycheck. Alright, so we're going to cover finance and investments. Let's kind of like at least zoom in on the little textbook that we're going to be using for most of this semester. We're zooming in?
Yep.
Is it nice? Mm-hmm. Alright. Textbook is Real Estate Finance and Investments. The latest is 13th edition. Bruggeman and Fisher. I was, for the previous semester, preparing actually for real estate finance to teach, but I didn't teach because there was yet another reshuffle back then. So I was preparing from the 12th edition. There is an extraordinary difference between the two editions. The previous edition did not mention the word bubble in combination in relation to real estate. In other words, real estate bubbles did not exist in the previous edition, or any edition before that. The 13th edition is extraordinary. It has one little box of 3 paragraphs which covers the latest real estate bubble in the United States. I mean, you gotta understand, it's gotta be the biggest joke in the world, which means that the textbook is woefully inadequate. We'll still cover, in my view, roughly, let's see what we have here. Out of 22 chapters, hopefully we'll cover about 13 or 14. Part 1 is introduction, basically some preliminary stuff, and then part 2 will cover almost entirely, which is financing residential properties. So financing residential properties almost entirely on how you raise the money and how you actually finance it, and it's related almost entirely to the liability side of real estate. Then part 3, financing income properties. These are more like real estate investments. 3 chapters, I'll cover probably about half of that material, what I find to be, 7 chapters, I'll cover about 3 or 4 of those. And then we have financing proposed projects. These are special topics in real estate, project development and land development. I think of entirely skipping these altogether. And then there is alternative real estate financing and investment vehicles, is something which I have at least specialized throughout the previous years, like secondary mortgage markets, pass-through securities, secondary mortgage markets, CMOs, secondary mortgage markets, derivatives, real estate investments, trusts. These are actually a lot more interesting. They are a lot more realistic, and one of the most important reasons is that they, in one way or another, actually contribute or contributed to the real estate bubble. Now, of course, we've seen a real estate bubble in Dubai, and you didn't have any or many of those instruments to fuel the bubble. So these instruments were specific to the United States, but it's important to understand them because they represent one of the most important trends in modern global finance, and this is securitization. So what I'll actually want to do is teach you more modern finance and emphasize heavily securitization as it has developed over the last couple of decades. It's a general trend which has been applied heavily to real estate, but it is not specific only to real estate. So this will have the objective of broadening of your overall worldview about finance as it is, in this particular case, securitization. Now, of the 22 chapters, I'm thinking or planning roughly to cover about 2/3 of them, not necessarily all of them. So what I'm also thinking of doing is for about a quarter of the semester to teach other stuff strictly related to real estate. I have accumulated a few dozen of very important real estate charts as real estate has developed during the bubble, because as far as I understand real estate, the most important aspect of understanding real estate is actually understanding bubbles. Everybody can easily and comfortably operate in a normal environment. It's kind of like you're a doctor and you're trying to treat patients which are healthy. Well, what's the point of doing that? What you actually want to be, if you're going to be a doctor, you actually want to understand diseases. Well, the primary disease of a real estate market is a formation of a bubble. We'll also try to shift to some extent, maybe 30% of the course to be real world stuff. We'll try to see as much as we can real estate bubbles in Eastern Europe. I've had a 2007, I think January publication about the coming real estate collapse in Eastern Europe. Well, back then when I published it, it was a total outrage because real estate markets in Eastern Europe were booming. Everyone was making money in real estate. Real estate was considered the hottest area ever, and we were supposed to become rich from real estate. Like we were building, hotels and vacation resorts around the Black Sea, and all Europeans would be coming. There were even big articles how rich Middle Eastern guys will be coming over there to vacation and all the good stuff. Well, it's already early 2009. 2 years later, real estate has busted, the bubble has burst, real estate has fallen anywhere between 10 and 35%, and now we all understand it was one big mirage. It was a self-delusion by investors and everybody else. Of course, you're a lot more familiar closer to home with Dubai real estate. Prices have fallen roughly. The estimate, which latest article I read, was 25%. Today, actually before coming to class, I also read about Abu Dhabi real estate market has completely frozen. Completely frozen means that the number of buying and selling of properties has fallen roughly 20 times. 20 times. In other words, whatever the number of houses, apartments, whatever real estate transactions were, now they've fallen 20 times. What has happened is buyers have vanished. No one is willing to buy. And sellers are not willing to give up the dream of making money. In this case, well, when we talk about Abu Dhabi, it means making billions from Abu Dhabi real estate. So what's going on is demand is rapidly falling. Buyers are willing to pay lower and lower and lower prices. Sellers aren't willing to budge. They're barely lowering 5 or 10% prices. But what Abu Dhabi did is follow the lead of Dubai. Alright? So, essentially what I'll try to do is make a real-world course in real estate as opposed to the theoretical stuff. Well, this one is actually fairly helpful, but it's helpful only in the first part where we actually understand the elementary concept. But the real world, unfortunately, is a lot more difficult, is a lot more complicated, and the complexity usually arises from bubbles. Now, in Bulgaria, we did not have any securitization process. We didn't have banks, commercial banks, finance the whole bubble 100% from the beginning till the very end. Right at the peaking of the bubble, the big talk was about securitization. Now, what you got to understand is this is not particular to Bulgaria. Securitization is a process where commercial banks and other real estate financing institutions are incapable of expanding the credit on their own and fueling the bubble. So what they try to do through securitization is to channel the financing to figure out somehow other people to actually finance the bubble. So securitization is essentially a channel through which you can further extend and fuel more and bigger bubble. So right at the peak means Bulgarian commercial banks were already choking on the mortgage debt, which they have, well, they have billions, more like 10, 20 billion euro in Bulgarian currency. They were already choking. They couldn't expand more. They can clearly see that they were choking. So the talk was, we need to securitize, which meant we need to follow the great American banking system. This is what Americans are doing, and we got to do the same thing. We got to follow their lead. Of course, this is the lure of the mania and of the real estate bubble. You simply watch and see Americans doing it. You simply think that because they are great, what they're doing is also great. But of course, the assumption is perfectly false. Well, the same was exactly the line of reasoning in that article I told you about Abu Dhabi real estate and development. All they did was follow the lead of Dubai. Dubai, what it did was supposedly great, or the greatest thing ever, at least in the Middle East, and all they did was just following their lead. Well, when it comes to bubbles, following the lead of the leaders is usually a bad economic policy and almost always ends up in disaster. I'll also try to find some interesting articles on the Japanese real estate bubble. It's one of the greatest lessons in history. What we know now, and this is important, I usually tell this story over and over in my investments courses, is that real estate can fall for a long time. Japanese real estate bubble peaked in 1990, and even today, 2009, March 1st, real estate continues to fall. In other words, for 19 consecutive years, real estate prices have been falling. Another lesson to learn from Japanese real estate bubble is something else. Government tries to reflate the bubble, but the bubble refuses to be reflated. So prices barely fall 2 or 3% a year. No big deal. What you hear from realtors, real estate investors, and developers is what? The market is going to stabilize next year. Well, next year comes, the market has fallen 2 or 3%. The market is fundamentally weak. Of course it's weak. It's weak because it's extremely overvalued. And then realtors come and tell you, well, the market is beginning to stabilize. By next year it's going to be growing again. Well, next year comes, real estate prices fall 3%, and the story repeats 18 times in a row. Now, why is this very important lesson? This is exactly what we're hearing today. Last week I read an article which said that Dubai's real estate will stabilize by the end of 2009, and by 2010 it won't be falling, and we could be expected normal growth. Normal growth, whatever normal means. We're going to talk about normal growth because it's very important. For example, in Bulgaria, when they're talking about the real estate bubble, they were talking about how we were growing at 30% and 30%. 30%. Of course, I was talking about the bubble. They just simply declared me incompetent. That's a lot easier to declare somebody claiming a bubble. It's a lot easier just to discredit, oh, he's incompetent, he's got no idea what he's talking about. Or, my preferred argument is that they usually tell that I don't really understand Bulgarian real estate, because Bulgarian real estate had very specifics. Of course, the Lebanese real estate's got specifics of its own. Of course, the Riyadh real estate market's got its specifics. Of course, Dubai is extraordinarily special, but also Bahrain. When you get to discuss, you'll actually realize that almost every market is remarkably stable. So, what they were saying is, Bulgarian real estate, that was like last year or a year ago, Bulgarian real estate is now stabilizing and will continue to grow at normal rates of 10%. Well, how do we call this? Well, you can call it by any name. Brainwashing, propaganda, self-serving statements. How can real estate possibly grow normally at 10%? What is the normal growth of real estate? Well, the problem is, textbook doesn't even bother to address this problem.
3%.
Huh?
3%.
Well, it should grow with nominal GDP. Nominal GDP. So, real GDP may grow with 2 or 3%, real GDP, let's say that's alright, but you may have 7% inflation. Should real estate prices reflect and incorporate inflation into their return? We call these total return or just capital gains. And the answer is yes, certainly. Real estate is one of the better inflation hedges that we know of, except possibly for gold. But it is a very poor hedge when it is overvalued. In other words, try to buy now US real estates, and you buy it extremely overvalued. Well, in an extremely severe inflation, 25%, 25%, 25%, 25%, it will be a decent inflationary hedge. But it won't be great. In other words, just because it's an inflationary hedge, it doesn't mean you have to invest in it. Just because you expect an inflation, and real estate is an inflationary hedge, doesn't mean you should invest in it. All it means is that you should invest in the best or in the most appropriate inflation hedge that we know. Sometimes, under some circumstances, it will be oil. Under other circumstances, it will be gold. It's a different topic of inflation hedges, but generally, in a strong, booming economy, especially in a strong, booming global economy, oil is always the better inflation hedge. In relatively weak economies and relatively weak financial system, gold is always the preferred and the better hedge. And we can discuss the differences, but probably not in this course. In other words, one of the most important goals that I have in this course, which of course is pretty much identical to the one in my investments course, is actually for you to begin to understand propaganda from investments and financial reality. Of course, it's totally and completely unreal to say that real estate will grow at 10%. Certainly not. Well, again, the other important thing to realize about real estate, which I emphasize in my investments, is that we can't say just it goes up 10%. Returns are always measured in something. It's going to be 10% in Saudi Riyal or 10% in Russian rubles. You have a total and complete bust in Russia and Russian real estate. Of course, Russian economy is extremely heavily dependent on oil, and for whatever other reasons, Russian economy is already being shaken. The banking system is on the verge of collapse, and they have cut dramatically on their lending, real estate mortgage lending. But the Russian ruble has collapsed already 50%. When you begin to measure real estate returns in Russian rubles, they're actually even a little positive. But when you get to measure it, actually in a stable currency like the dollar or the euro or the Swiss franc, it has been a major crash. So just saying 10% return, you must always specify return in what? I mean, every American will tell you that from 2002 to 2007, real estate in America provided extraordinary returns. Well, really? Let's measure it up against gold. Has it actually appreciated against gold? How much did real estate prices go up in the United States in those 5 or 6 years? 100%, maybe 150. In other words, they've doubled, but certainly not tripled. Well, why measure them against dollar? Dollar has been falling. Dollar is a poor value measure of value. When you actually get to measure it against gold, you get a completely different story. It has been losing every single year up against gold. Questions? No? Alright, so it is extremely important to figure out all of those elements of propaganda, and what I'll try to do and what one of my goals are is actually to cover this in the last third of this course. Now, let's try something else to throw out very early in the course. Real estate is always claimed to be the best investment in the world. Certainly not true. Certainly not the case. Now, here's another claim. Real estate always comes back. What does it mean always comes back?
Recovers.
Yeah. Always recovers after a crash. True or false?
True.
Yeah, true, but try invest in Roman real estate in the 400s. Before the Vandals and the Huns or Huns, or whatever you want to call them, actually invaded and burned Rome. How long would it take for Roman real estate to recover? Maybe 500 years.
Yeah, but the general rule is in most of the countries, it's true that it recovers.
Most of the countries is true, but that's the point. Most of the countries is true, but the point is, does it recover in your lifetime for you to benefit if you invest? That's the key to understand. Is it certain or most likely that it will recover in Japan? The answer is yes. Extremely likely. Chances are 99.9 it will recover. But suppose you're a young man at the age of 25, supposedly you are, and suppose you invested in the peak of the bubble because real estate was so terribly expensive in Japan that at the age of 25 you invested, and of course you overpaid 3 or 4 times the price. Of course you took 50-year mortgage because supposedly you're going to live long and pay it back by the age of 75, and look at it 19 years later. What's going on? You are, instead of 25, what? 40 years old. You're going to turn 45. And what do you have to show for your investment? You show for a 70% loss. In other words, for 19 years, real estate prices in Japanese yen have fallen 66, 68, 90, sorry, 70%, between 60 and 70, depending how much it was overvalued. So the one thing you got to show for your investments is a 70% loss. Well, it may come back, but the question is it going to come back in your lifetime? Is it going to come back by the age of 65? And if it comes back by the age of 65 and you recover your losses, what have you done throughout your lifetime with your supposedly biggest investment? You invested at the age of 25, and at the age of 65, close to about retiring, all you've done is zero return. Zero return. And the return, remember, is measured in Japanese yen. So the Japanese yen, of course, is also falling. Just because it's rising up against other currencies doesn't mean it's falling, right? How do we know the Japanese yen is falling? We just look at the chart of gold in Japanese yen. And we know and see that gold keeps rising and rising and rising and rising up against yen. So it turns out that you've made a good investment, supposedly. The investment comes back, but it doesn't come back for your life. You continue for all of your mature life, meaning from the age of 25 to the age of 65, you've actually made a really, really bad investment. But you have something else to show for your investment at the age of 45 besides 70% loss. What else do you have to show for? You have to show for a mortgage which is still and 30 years more to pay. Usually in Japan's bubble, people borrow, not like Americans for 20 and 30 years, they borrowed 50-year mortgages and 100-year mortgages, where they mortgaged and they obligated not only themselves to continue paying to the bank, but also their children. How do we call this in modern political science? We call this debt servitude. In other words, the father makes his son and children servants to the banks. Because the child which is not yet born at the age of 30, when the father retires, the son will inherit not the house, will inherit the mortgage obligation towards the bank. I mean, these are some of the realities which in this great textbook aren't even mentioned. They don't exist. Of course, the reasons you understand by now is they don't really want you to understand those things. Alright? Otherwise, you'd be smart enough not to be buying into real estate bubbles. Alright. Let's see where we're doing. Questions before I get with some boring stuff on... is this guy good for introduction? Yeah, for exams, for other things, I'll be sending you emails after that, and everything's going to be posted. So let's focus on real estate and whatnot.
Sir, nowadays in the US, the real estate, is it still overvalued?
Yes, of course. What is Peter Schiff saying, whether it's overvalued or not? Yes, it is still extremely overvalued.
Because when you read the Financial Times, they say it's the best time now to invest.
Yes, of course. What is the goal of Financial Times? The goal of investment of Financial Times is to sucker in, if they could, Chinese investors, Japanese investors, and Middle East rich investors to buy back into American real estate. Is this going to be good for America if, let's say, Saudis, Chinese, and Japanese actually come and buy real estate in the United States? Is this good for the Americans and for the American banking system, for the American establishment? The answer is certainly yes. And it will be even better for them if real estate is overvalued. In other words, if real estate was dirt cheap, they're going to sell it to their own citizens. Alright? So that their own citizens can benefit. But if it's overvalued, you actually want to stick it to the foreigners, whoever they are. Alright? So what they're saying is, in their own financial and banking interest, but is strictly untrue and strictly to or at the cost of investors, in other words, at foreigners. So, foreigners are going to be buying it, and then they're going to suffer the losses. Well, great. Plus, when foreigners buy today, they will, with their purchase, liquefy an American bank and banking system. And also, the purchase of a foreigner of real estate helps to finance the capital account. So, in other words, the current account deficits will help finance them. All right? Is that clarifying question?
So, sir, we should stay for the coming 10 years away from investing in the States?
I never said for the coming 10 years. You said it. All we want to say is for as long as real estate is overvalued. Now, when you have a bubble and a bubble bursts, real estate prices never come to normal valuations. When bubbles burst, the general rule is always that bubbles, once they burst, valuation from extremely overvalued always overshoot to extremely undervalued. So what you want to see is real estate become normally valued, and then wait 1 or 2 or 3 years, and then get into the real estate market. Questions?
What kind of tools can help you to know that real estate is not undervalued?
Okay, so what are the tools that help us know that real estate is actually overvalued and undervalued? Right, this is an excellent question, right? This is participation point for the best question. So, the textbook will give you all sorts of really nice and fancy ways to figure out is it good or is it bad. Let's go and jump directly to this. So, of course I'm going to proceed with a systematic lectures, but let's try to address some of those issues. So, first of all, we want to find out valuation. Well, one of the best ways to know if you got a bubble or not is what is the price, and when I say price, I mean median price versus median income. Median price versus median income. When I say income, I mean annual income. During the bubble in California, price-to-income ratios went as high as 6 or 7. What is the meaning of the interpretation? It means that if you use gross pre-tax income to purchase the real estate, it's going to take you 6 or 7 years of income when you don't pay taxes, you don't eat, you don't drink, you don't sleep, you don't use TV, mobile, or anything else. If you only hibernate. Alright? So, what is considered to be a decent valuation?
2 to 3.
2 is considered to be a good valuation. Alright? 1 is considered to be well undervalued. This is what Warren Buffett will call a good value. Is 1 realistic? The answer is yes. It is not unrealistic to be finding these, although it's not very common in a particular country. 3 is overvalued, clearly, and what we call bubble territory. Bubble territory. So, here is now you're asking about how do we find out in terms of valuation whether it's overvalued, whether it's undervalued. What I'll pose to you in a coming exam, and of course will be, well, how did Peter Schiff tell in 2003 or 4 that there is actually a bubble in the United States? Alright? So, we're going to try to figure this out. So, price to income is definitely one of the better ways. Now, in Bulgaria, real estate at that time was between, the ratio was about 7 or 8. In other words, Bulgarian real estate was even more overvalued than California real estate. Yet everyone in Bulgaria will tell you that It is not overvalued and it's not normal. In a real estate bubble, you always have what is called a rationale, a justification for why the bubble occurs. In Bulgaria, the justifications were two. Number one is we were entering the European Union, so prices, Bulgarian real estate prices, must equate or equalize to European prices. All right? That's the first argument. The second argument was Bulgaria is an extraordinarily beautiful country and everyone's going to be coming to visit us and vacation and everything else. All right? Well, what's wrong with the first argument and what's wrong with the second argument? Well, you ask Ukrainians, they'll tell you their country is phenomenally beautiful. You can ask Mohammed, Lebanon has got to be one of the most beautiful countries in the world, right? And you get to talk to all people and they're going to be telling you that, you know, of course, their half of country or whatnot is extraordinarily beautiful. So the argument that just because it's beautiful, the rest of the world will come over there is not a reason to justify overvaluations, all right? All it does is it will justify higher rents, meaning higher income. And if it justifies a high income, it will justify a higher price. But what they were trying to do is to justify the higher price without the higher income. For example, Europeans actually would go to Slovenia. Slovenia is just as beautiful as Bulgaria. Europeans would go to Italy, all right? Europeans will go to France, you know. So you have so many beautiful places in the world, but the logic was everyone's going to be coming to Bulgaria. Now, about the equalization of prices. Well, let's try this. Where I lived in the United States, in Columbus, Ohio, for 10 years, from 1995 to 2004, Columbus, Ohio has been in the United States for almost 200 years. Well, it was established like 150 years before that. And guess what? For 150 years, Columbus, Ohio real estate never, ever equated to New York real estate. It never caught up. Actually, if you look at historical charts, you'll see that Columbus real estate is usually between 2 and 3 times cheaper. So, just because Bulgaria enters EU, in no way would possibly mean that Bulgarian real estate will equate to European levels. In other words, one of the fundamentals determining price is actually productivity. All right? By the same token, would you expect just because Syria entered GCC, if it possibly could happen, hypothetically would happen, that Syrian real estate will suddenly equate to Dubai or Abu Dhabi real estate? No, of course not. Certainly not. But the problem is that 7 million Bulgarians got fooled by the simple argument. Well, the problem is that if it happens that Syria would one day possibly enter, what it would mean is that people will begin to think is what's the logic of, let's say, Syrians or somebody else, what's the logic of thinking, oh, we're going to be entering GCC, no more visas and whatnot. Well, the logic will be rich Saudis and Abu Dhabi and whatnot will be coming to buy their real estate, right? So usually before you enter some kind of a bigger union, the people inside already pump themselves up, and of course the banking system helps them out, to inflate their own bubble. And usually when they already enter with a wildly inflated bubble. Example will be also the unification of Germany. Germany, now in 1991, Berlin Wall fell, and 2 years later, so it fell like 89, and 2 years later, what you had was the two Germanys merged. When the two Germanys was merged, the logic went that suddenly we are one Germany. And if we're one Germany, real estate prices in Eastern Europe will equate real estate prices of East Germany with Western Germany, all right? So suddenly a wild and crazy bubble, real estate bubble, inflated along the way, and everyone was investing because prices, Eastern European prices, must necessarily inflate and catch up. Well, guess what? People found out 7, 8, 9 years later what Bulgarians are finding out now. Just because you're in Germany doesn't mean that your productivity will go up. In other words, you have those Eastern European cities with Eastern German cities with Eastern European culture of not working too hard and all those things, which prevented the Eastern European German cities to actually get the productivity, get the income, and by getting the income to raise the fundamentals of real estate. So, people never got the higher incomes. Same in Bulgaria. We joined the European Union, 26th, 27th member, but our incomes didn't actually go up. All we did was inflate a wild and crazy real estate bubble where the ratio was 7. But they justified that it was normal, that it was okay, that there is no problem. Well, this is what I will be trying to do throughout most of these courses, to at least help you when you see a bubble to know that it's a bubble, alright? Because it's very difficult to define.
Sure.
Alright, let's see.
So we can say that the high productivity,
High
productivity justifies high prices for real estate.
Okay, so yes, that is absolutely true. So the logic goes like this. Cameramen, are you zooming in? A country with very high savings will mean very high investments. Now, in a closed economy, which you don't have capital inflows and capital outflows, savings are identical, mathematically equal to investments, always and at all times. It is an accounting identity similar to assets equal liabilities. Now, high investments certainly mean rising capital or increasing capital per worker. So, higher savings results in higher investments. Higher investments result in higher capital accumulation. Alright? In other words, the process of raising or increasing the total quantity of capital in the economy is called capital accumulation. Now, higher capital accumulation, or meaning higher capital in this case per worker, results in higher productivity. This is one of the most fundamental relationships in macroeconomics. Now, let's explain a little bit some other big economics. According to Keynesian theory, if you boost consumption a little bit more, by boosting consumption, you boost the GDP. Alright, is that fairly well understood? So, if Americans consumers could just eat a little bit more and become a little bit better, that will solve the macroeconomic problems of America. If they were buying just a little bigger cars and a little bigger houses and a little bigger everything, they would solve the current ills of the economy. However, if they were buying more, it certainly means that they'd be saving less. If they've been saving less, this means they'd be investing less. They will be accumulating. The opposite of capital accumulation is called capital decumulation. So they're actually losing capital, and therefore they will be losing productivity. In the end, productivity or growth of productivity determines economic growth. So productivity has two branches now. One of them is called growth. Excuse me, guys. Economic growth. So, the more the American consumer spends, and the more the US government spends, the more they doom the American economy to slow or no growth. Essentially, what the recession or depression will do is return or normalize the economy to a growth rate commensurate with its capital base. The total quantity of capital in the economy we call a capital base.
And how is the GDP increasing?
Well, the GDP is not. The GDP is not increasing.
So it's not true that when they overconsume that the GDP...
Okay, that's what I'm trying to explain. When they overconsume in the short run, it boosts the GDP. But in the long run, it hurts it. The best equivalent I've ever found, Peter Schiff uses a similar one, is an athlete on steroids. In the short run, you shoot the steroids, he runs better. Is it true? Yes, of course. Is he a better athlete? The answer is he appears to be better. Well, what do you do next year when comes the next tournament? Well, the answer is no, you shoot even more steroids, alright? You pump up even more. Well, next year he does even more. Well, 1, 2, 3 years, yes. But eventually you end up with a completely ruined health. You become, health-wise, completely devastated. You're busted completely. You're no more a normal human being. Well, for the economies, it's quite similar. Yeah, you can boost it once, maybe a second time, maybe a third time, but you can't keep shooting the drugs, whatever they are, and expect a better result. Eventually, you will collapse. It is true. In the short run, you could get a better result. Higher productivity means higher economic growth. This is true, but it also means higher income. Higher income could be higher potentially capital income. It could mean higher wage or labor income. In other words, earnings of labor will be higher. Well, if earnings of labor will be higher, this income here is identical to this income. So, if we were just through better investments and better capital, better possibly, now in capital, we add one other little piece, which is well understood by all economists and no one is denying it. We include the piece of education. In other words, part of investments, we add here education. Education. So, education is an investment in, how do we call it, guys?
Self-investment.
Yes. Alright, so, investments increase capital. Education is a special type of investment. What is the result?
Skilled labor.
Huh?
Skilled labor.
Yeah, how do we call skilled labor?
Labor force.
How do we call it?
Knowledge workers.
Alright, let's add this in. Let's teach some elementary stuff. Have you heard of human capital? Yeah. Alright, so education increases human capital. Alright? So, human capital also results in, of course the logic is identical, also results in increased productivity and certainly results in higher income. Well,
it's a Japan case basically.
Huh?
The Japanese have good human capital.
Yes, Japanese have good human capital. Singapore is now claimed to be doing well in human capital. Hong Kong is doing fairly well in human capital. Eastern Europe was really good in human capital, but bad on real capital. Sometimes we call it physical capital, alright? You also have this intellectual capital, but I don't want to get into that. The point is we're trying to answer Mohammed's question is income, rising income of workers, we call these earners in general, will certainly justify higher prices and higher valuations. Is this kind of beginning to answer it? Alright, so now, valuation in a Warren Buffett style is widely recognized. For any asset depends on income. Alright? Now, real estate has income. How do we call the income of real estate?
Rent.
Rent. In other words, this income is not equal to this income. This income is the return on labor. It has nothing to do with rental income. This income is return on real estate, alright? So, income as in rents, and we divide it, whether this one or this one, it's the same thing, by what? By price.
Purchase price?
Yes, by the purchase price or the investment price. Now, how do we call this rent to price ratio? That's from like the last lecture in the investments course.
Right.
Yeah, from the investments course we did it last time, remember? Huh?
Price earning ratio.
No, we call it rental yield. Let's clarify here. Let's make the Peter Schiff connection. Stocks provide dividends. What Peter Schiff keeps talking over and over and over again is the dividend yield. In other words, the dividend of the stock divided by the price of the stock. In other words, what is in percentages the income from the purchase price or the investment price, or maybe the current price. Alright, so rental yield. Now, let's add one more word of terminology to be sure that we understand it. Hold on. Is the word current. When you say current dividend yield, it certainly means the current dividend, today's price, divided by the current price, the current dividend. So usually, when you're making valuation for a particular asset, you always want to measure it not against your purchase price, which is always irrelevant. You may have bought for 1 or for $1 million. You always want to measure it up against your current yield. So for a stock, we call it a current dividend yield. Alright? For a bond, will be also current dividend yield. Alright? For real estate, will be current rental yield. Alright, so the current rental yield will determine the valuation. Well, what's good, what's bad for a current yield?
The higher the better.
Yeah, of course the higher the better, but this is every little kid will know without coming to college.
Sometimes the current price can be overvalued.
Yes, you're stating the obvious. Apparently that's relevant. Whether it's overvalued, it can be overvalued. Understand? It can be overvalued, it can be undervalued. It's irrelevant. The question is, how do we determine whether the yield is good, meaning high, and if the yield is high, the asset is undervalued? And how do we determine if the yield is too low and the asset is certainly overvalued? That's the question. You know, you're telling me what could happen. Every little kid knows what could happen. The question is, what do we determine? How do we determine yields?
The price?
The market.
Oh, market by what? By what? No, go. Now, for you, I'll begin to have penalty points. Because you're going to accumulate quite a few pretty fast. Alright, this is the most elementary in all of finance, actually in all of investment. First of all, the yield must include certainly the risk-free rate. If US government bonds are yielding 3%, it has got to have those 3% at a minimum, right? What else? Inflation, of course. Inflation. It has to have an inflation component. Somehow there has to be an inflation component. And there's got to be something else. What else? Risk premium, correct. Risk component. Risk premium or risk rate or risk compensation. In other words, if you're going to be having yields, they better be compensating you for both the normal returns, risk-free, to compensate you for your risk, and also to compensate you for inflation. So, let me give you what we call rule of thumbs, which should easily apply to Saudi Arabia today, given the current inflationary environment. 5%, let's say, rental yield. So, now I'm doing this table over here. 5% is interpreted as low. It means overvalued. 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 Alright? Exactly. Now, 10% we can say normal. Well, what does it normal mean? Normal means 3% return on risk-free. Normal means 3-4%, maybe 2-3% inflation. 10% means maybe 3-4 up to 5% compensation for risk. Because real estate is risky, alright, as Bulgarian and Dubai and American investors understand right now. So, this means overvalued, this means normally valued, properly valued, let's call it in English, well valued. Sometimes they use fully valued, fully valued. And then you could potentially get 15%. And this is a high yield, this is a really good yield. Is it realistic? At certain times, the answer is certainly yes. And here, real estate is undervalued. So, back to your original question, which got me on this 30-minute, sidetrack, is if you're seeing that the median income of the average, whatever, Saudi or Lebanese, American, Bulgarian family is twice the price. In other words, the price does not exceed 2. You're good to go, meaning good to buy, good to invest. If, by the same token, you see that rents are roughly yielding 10% annually, this means it's properly valued. Now, here is an even better and easier way to think about it. It's very dumb, in a dumb manner, but it works really well. If the house is 50,000, doesn't matter, real, dollars, euro, and the rent is 500, it is more or less properly valued. It is more or less good for investment. Alright? So, this is the better way. Well, how is this 500 aligning with the 10? And the answer is, it is not. 500 means effectively 6,000. Means effectively 6,000. Do you see the 6,000? 5,000 is per month. 6,000 is the annual. Alright, so now, what's the rental yield? 6 divided by 5 is equal to, in this particular example, 10.5%. Wow. Apparently the department chair was right. I gotta give you one example like this, and no one's gonna get any. 9.5. I'm thinking of 12, I don't know why. You guys don't have all those fancy gadgets like the calculator. You see, we got one smart guy. What is he doing? He's just dividing 6,000 by 50, or maybe just checking his, SMS, right? You divide 6,000 by 50. So, 6,000 is the annual income. 50,000 is the current price. 6,000 divided by 50 is
12%.
12%. So what 12% is telling you, of course, is that it is looking on the good side. It is good to invest, all right? This we call in English, and in finance and investments, a general concept known as a rule of thumb. Rule of thumb is a general guideline which is based on some firm and steady rule, but provides only an approximation most of the times. Alright? So it is not always valid, not always true, but 90% of the times it will give you a good guide. For example, I was asked just recently, last week, about investing in real estate in Lebanon, in Beirut. And I asked a simple question, well, what is the current rent and what is the price? In other words, is the rule of thumb satisfied or not? And what do you think the investor told me? They told me, I don't know. Alright, so the point I'm making is that this is known now as, at least in the industry, in the business, amongst investors, the 1% rule of thumb. Of course, it's not in the textbook, because textbook just gives you a lot of theory. But in the real world, if you're going to be investing, you definitely want to check to start with the 1% rule of thumb. Alright? Is this guys good enough for today so I can go home? And next time we begin with chapter 1 from the textbook. It's long, it's hard, it's long, and it will be nice if you actually buy yourself the textbook and try to read it before you come 2 days from today. Alright?